Hey guys, welcome to the Investor's Guide of Memphis Real Estate. I'm your host, Dean Harris, and as always, I'm with Douglas Skipworth. How are you, buddy?
Hey man, doing great.
We're bringing you this podcast to give you the boots on the ground knowledge to be a successful real estate investor here in Memphis, Tennessee. Please like and subscribe to all of our Spotify, all of our pages, YouTube, Facebook, wherever you listen to your podcast. Please like and subscribe. Zoom calls. I am doing the Zoom calls again. We're going to do one tomorrow, Thursday, at 2 o'clock. If you'd like to be part of that, just shoot me an email, dean@CrestCore.com. Show sponsors are listed at the bottom of your screen there. We could not do this without those guys. CrestCore Property Management, Corlin Financial, Will Griffin and Griffin Clift Everton and Mashmeyer, Local Title, and Triumph Construction. Yes. For all of you guys that are that can't see the visual there, appreciate all those guys. Couldn't do our business and our show here without them. I do have a deal of the week this week. Excellent news for all of you that are looking to buy. 271 T.M. Henderson. 271 T.M. Henderson. This is in 38107. Vacant property listed at 114.9. It's a 4-bedroom, 1-bath. This is a $1,100 to a $1,200 rental. I've been in this one just this week. Excellent condition. Little broom sweep. Not very much that needs to be done to it, and it'll be ready for a tenant. This seller is looking to move this property. So give me a call, dean@crestcore.com, or I'm sorry, give me an email. I'll be happy to help you. 271 T.M. Henderson. It's in 38107, 114,900, 4-bedroom, 1-bath. It's 1,000 square feet, 1,100, 1,200 rental. And this property is vacant now. So right at the 1% rule, maybe a little bit better than that, which is an excellent segue into our show today, which we're going to talk about the 1% rule. Many of you might not know what that is.
Yeah, what is even the 1%? What do you mean?
Yeah, it's a strategy and it's a process, a numerical strategy that guys use that it's 1% of the purchase price. So as an example, if you, go ahead.
114.
Oh yeah, 114. We're way better on the deal of the week. You know, if it rents for $1,200, you're a little bit better. If you can get it, for 110 and it rents for 11, you're right at it. And this is a home that needs no work. The guy did a complete and total remodel.
The monthly rent is 1% of the purchase price.
1%. Yep. That's what, if you hear somebody say, we're looking for the 1% rule, that's exactly what they're looking for. They want to be all in. Their purchase price needs to be 1%, or 1% of the purchase price is the rent. So
the month, okay.
Yeah, is the monthly rent. So, in most markets and in most climates, this works.
Yeah, good rule of thumb.
Good rule of thumb. You can typically cash flow with the 1% rule. Interest rates are going to vary, and you might have some different math on different properties. But in our experience, the 1% rule is kind of the minimum of what guys want. If it's a new construction, they might take a little bit less than that. But for the most part, investors, in my opinion, are looking for at least that 1% rule.
Yes. I think that you don't want to kid yourself and overpay for something. It's not a fact. It's a rule.
There we
right?
go.
So just that house you gave, that 114, 9, you said it's going to be between 1,100 and 1,200. So that's 110 to 120.
Yep.
In there. So that's right in there. Mm-hmm. And if somebody paid 130, would they get 1,300 market rent?
No.
But that's the 1% rule.
That's right. So what you've got to make sure is that your market rent and your price match up. Just because somebody is listing it as 1% rule, it'll rent for $1,500 and I'm selling it for $150,000. I'd make sure that the market rent and the ARV comps and everything matches up. That's what you don't. I guess if there's a pitfall to this, is falling for or believing or just going off the numbers of the house and not looking at market rent or ARV comps.
Yeah, I paid $150, so it should rent for $1,500.
Yeah, I wish that was the case.
Right.
Man, I wish that was the case. No, you've got to definitely make sure that your market rent matches. I mean, that's an excellent point. Just because you buy a home for $200,000 has no reflection at all that it's going to rent for $2,000. None. It could, but not because you bought it for $200,000.
Right.
Your tenant's not going to go, man, it's a $200,000 house. I'll pay $2,000.
Right.
Yeah.
But in general, when you're looking at market rents and you're looking at market values, they should equate out to the 1% rule.
And typically sellers are making that match. especially if it's an investor seller, they understand that other investor buyers are out there looking for the same thing. So that's what I'm finding now. So that's I think the podcast was it last week or 2 weeks ago we did on what's selling right now. And it's the 1% rule houses. These are all selling right now. We're last year, and I know what it is. It's a direct reflection from last year. Myself, we've documented this and talked about this, but we sold 300 or 400 homes that needed a ton of rehab last year.
Yes.
I'm not saying every one of these that are coming out are those, but I am re-seeing some addresses. These guys are taking the homes, buying them, rehabbing them, and selling them for the 1% rule because they know investors are looking for that.
That's right.
So that's what we're seeing this year. It's zero coincidence that that's how it's happening. They're not all mine. There's other agents that sold Burr properties last year that are now coming up, but that's what we're seeing right now.
And I think one other thing to point out is in some neighborhoods, the 1% rule isn't going to work because it's a predominantly owner-occupied neighborhood.
100% true.
I mean, are the values. So in Memphis, let's say you find a $350,000 house. Pretty hard to rent it for $3,500.
Pretty hard.
Maybe $2,500.
Maybe $2,500. And in this market with the interest rate as high as it is, you have a little bit better chance to get that rent, right? Now.
Sure, because people aren't buying homes.
They can't buy a home because it's the same 35, so they might as well rent. However, you are right. It's very difficult. The higher price you go to get it to match. So I'll give you some examples around town. In Cordova, it's super tough, right? Your houses are 170 to 250 for the most part.
Yes,
those aren't necessarily renting for 17 to 2250 or whatever the number was. Bartlett is tough. Right? Germantown and Collierville are obviously tough, right? Where do they work? They work in Raleigh. They work in 38128. They work in 38127. They work in 38118, 38116, 111, 115 in some cases, 141, 109. So anywhere in that 80 to about $150,000, $60,000 price range is where we can find some 1% rule houses. Now, you've got to be okay with being in those areas, and you and I both own in all of those areas. As a matter of fact, that's where I focus on. I don't buy many Cordova, Bartlett type properties. For that, you can't get 1%, right? Because you can't make it work. So most of my properties are in those areas that I just mentioned, those zip codes. And then the zip code breakdown that we have on the YouTube channel is there. You can go back and re-listen to that, and we talk about those specific rental markets and numbers and all that. So
that's good.
I am sensing your caution on it, and I think it's a good thing to bring to this because you can't. Because I think
I just don't want people to hear when we're talking about 1%. It's a rule of thumb. I just don't want people to say like, "Oh man, I'm going to pay $150. Why am I not getting $1,500 rent?" Well, because the market value is $1,200. That's right. For rent in that market, you just overpaid, or you come in with a $350,000 house that you think should rent for $3,500, and you're like, man, I could maybe get you $2,700.
Right. So another one of the cautionary tales or the cautions that I talk about with the 1% and with these rental properties is with a turnkey provider. I'm not here to bash a turnkey provider. Man. We love those guys, and it serves a good purpose for the right investor. But what I caution on is when you buy a 1%er from a turnkey provider, that's basically a new home, right?
Yes.
And as the years go on, it's no longer going to be a new home, and that rent's going to settle back down to the market rent. It's going to take some time. I'm not saying after one tenant that's going to happen, but I caution you on buying a 1% turnkey property with the expectation that you're going to keep it for a long time. And if you aren't keeping it for a long time, that's probably not the product to buy anyway, because you're buying at top of market value, and there's just a whole bunch of, there's no exit strategy with it. So this podcast is not to down a turnkey provider or to tell you that that's not a good product. I just want to caution you on the 1% rule factor, that just because you see that now on a turnkey property doesn't necessarily mean that in 2 years and 3 years you're going to be able to see the same rent.
That's right. And that's a good lead into what I wanted to say as well. On the turnkey, 2 or 3 years is probably too short. Mm-hmm. But after 10 years, the rent and the value are both going to increase in that property. We've seen that. Our experience shows that over decades. Yeah. And that is what I was going to say is when I went back and looked at portfolio of properties I've owned more than 10 years, just because of the way they're financed, and I've got them now, they're probably on the debt I owe because of the way the rents have increased. They're probably 2%ers.
Yeah.
So that's going to happen to you, that what might be a 1%er or maybe a 0.95%er
Yep.
could grow over time as the value of the home and as the pay down, as the rent goes up and the pay down goes down, such that your debt you owe on that house to the rent is over 1%.
That's right.
Not to mention that I think the value on the homes as I go out and look at them are probably in that 1% rule.
That's right.
So even though I owe 2% rule, but they're valued at 1% rule. So I've got some equity in them because I've owned them for a long time. I've been paying down on that mortgage.
Yeah, there's probably several that I've got that have turned into that. A lot of that you can get over here in Berkeley or 122.
Yeah. But that's what it's telling people that in the short term, that's really hard.
Yeah.
But over a 10-year period, we talked about your young friend who said that rents are here today, but where are they going to be in 10 years?
Oh man, that was an investor changing phone call for me. And what that was, real quick, the guy was a New York young kid, not a day trader, but a broker guy on the floor. Retired, made enough money to retire from that, moved to Nashville, turned into a real estate investor. And one of the things he said, I mean, he was 26 when I spoke to him. This was a couple of years ago. He was 26. And one of the things he said was, why? Because he was like, hey, I want these 220 houses that'll rent for $1,600 and $1,700.
Less than the 1% rule.
Way less. So I always have this conversation with an investor. Hey, why are you doing that? And do you understand I can get you something better, right? They might have their own reasons. And this guy did. He goes, no, this is what I want. I go, Tell me why.
Tell me why. Help me understand.
I'm in this business and I don't understand. I sell this every day and all day. And he goes, well, the way I look at it is I'm young. I'm 26 years old. He said, this is a long-term game for me. And he said, can you imagine if Memphis just took the standard 3% a year raise in rent and in value, just the standard. Now, you're not going to get it year after year.
Yeah, it's lumpy.
It's lumpy, but let's just say every 10 years. And by the way, in my research, in Memphis has gotten that. So I'm like, dang, he's already done all this. So he comes back and he just said, hey, in 10 years at 30% more of 1,700, which is 5,100, it's $510 more. So now you've got a $2,200 rental and the home is now a 1%er.
Yes.
He goes,
what he paid.
Now the house is worth $300,000 because it's gone up. He goes, so now in 10 years, I've got a $2,200 rental, $2,300 rental that I only owe probably $200 or less on now because I paid the debt down, and it's worth $300.
Yeah.
He goes, so how many of those would you take? And I was like, as many as I could handle. So he really opened up my eyes to a different thought process. Now, takes the right strategy. You got to be able to weather that short period storm. You know, low cash flow. So you've got to be able to do that. But if your game is long term. This kid had the right idea for it, and he's bought several. He's still buying.
That's awesome. It's a long-term game. That's what it says. We talked about this a couple of weeks ago with the tenants about, had a friend who had a troubled tenant to begin with.
Yeah.
He got that troubled tenant out, and then 15 years later, he's got a paid-off house that's doubled in value. There are two things it reminds me of. Number one, my son's a Boy Scout. Everybody who has ever got to Life Scout, which is the scout right before Eagle, always says, I wish I had been an Eagle Scout.
Yeah.
I regret that my whole life.
That
I stopped. Just as many times as I hear that, I hear, I used to own rentals. I wish I had. I wish I had all those rentals that I sold. My parents had rentals and we sold them. Whatever the excuse, everybody always regrets that they get out in the short term instead of waiting for that long-term payoff.
Yeah. So, in what you're saying is just the business. If you got that property you get out of, let's get out of it. But the real estate business. Great point. I would hate to.
Yes.
I have many people that have come back and said, I wish I hadn't sold them all.
Oh, that's right. Yeah.
You've even admitted that some of it's good to get rid of. But
cull the portfolio.
But selling it all and being out of the business you'll have some regret.
Yeah. Great. Clarify.
Because you'll look up in the house, and don't tell me you won't do some research in 10 years. You'll look up and say, oh, 123 Main Street I owned would be worth this. And that. You'll have some regret. So 1% rule, great strategy to stick to. Anything else that we need to cover? I guess some of the things to watch out for, some CapEx expenditures, make sure that you're calculating for a roof and an HVAC, screen your tenants properly. You can't really afford any errors. You need to make sure that they're there. And then make sure your property management team is aware of the strategy. CrestCore Property Management handles this all the time. They understand that what we're looking for is the 1% rule. So those are just some things to kind of keep an eye on. And then, make sure that, like what you said, is that your market rent is actually that 1%. Don't assume that just because you buy a house for $140,000, it's going to rent for $1,400. Make sure you're verifying all that.
Yeah.
Anything else?
Great.
All right, guys. Thanks for tuning in. Dean at CrestCore.com. If you want to hit that Zoom call tomorrow, and if you have anything else, questions on deal of the week or whatever, shoot me an email. Dean at CrestCore.com. Thank you.